Okay, great. Sarah, thanks for the introduction. And I'm really pleased to be here today, joined by four of our outstanding portfolio managers. Let me give them a quick introduction. We have from London, Tom O'Hara, who's a portfolio manager on the European Equities Fund, Jeremiah Buckley, who's portfolio manager on the growth, income, and balanced strategies, Ben Lofthouse, head of global equity income, and Brian Demain, portfolio manager on our mid-cap growth strategy. Thanks for being with us all today. We're going to get right into it. The cost of capital is increasing and credit conditions are tightening. So how are those factors influencing your view of the market and security selection in particular? Tom, why don't we go ahead and start with you?
Sure. Thanks, Michael. Well, very simply, it's making us more valuation sensitive. We think inflation is actually going to be quite sticky, not necessarily 9 to 10%, not Venezuelan levels, let's say, but certainly in the mid-single digits. So with that in mind, we see more of a plateau in rates rather than a pivot. And that means you're going to have to care about valuation, certainly more than you did over the last 10 to 15 years. So when we're looking for quality companies with pricing power and other various attractive business attributes, we also want to know that we're paying a decent or a fair price for that asset.
Great. We really appreciate that insight. Jeremiah, why don't we go to you for your thoughts?
Yeah, sure. With more restrictive monetary policy and likely slower real growth, we believe that companies with secular growth advantages will lead equity market performance. We believe in environments like this, it's really important to focus our investments on higher quality companies, as Tom said, companies with strong capital positions and companies with warranted pricing power. Companies that have flexibility on their balance sheet and consistency in their cash flows can use that as an advantage over companies or competitors that are more reliant on looser financial conditions. Also, in an inflationary environment like we've seen, we think it's imperative to focus on companies where their products and services have been creating incremental value for their customers for years and have earned the right to raise prices to cover inflationary costs and maintain profitability.
Great insights. Ben, why don't you share your thoughts?
Yeah, thanks, Michael. I think we've been worried about rates, going up from a very low level for some time. I think we probably feel the immediate valuation impact on markets is largely felt. So we've seen a big rotation in certain areas. I think the bit that we think is maybe not felt yet is the impact if they stay a bit higher for longer. So the actual refinancing impact on companies is something that analysts quite often don't factor in until the actual bonds come due. So they're going to be higher interest rate costs. I think also the credit spread environment has been very tight. So in terms of banks and financial companies, we haven't really seen very much credit impairment either. So we're a little bit wary on that. We obviously hope it doesn't come, but those would be kind of the two areas we think are probably underappreciated by the market as a risk.
Wonderful. Thanks for that. Brian, why don't you bring us home on this topic?
Sure. Thanks, Michael. And I'll probably echo a little bit of what Ben's saying and expand on it a bit. I think obviously we've seen rates move higher in the short term, but I think probably the bigger idea here is that rates are going to be structurally higher over the next 10 years than they've been over the last 10. And if you really think about it, we've had 40 years of a disinflationary force in the economy, from Volcker to NAFTA, to the WTO, to the deleveraging caused by the global financial crisis. And now we have a very different backdrop, and I'll call it the 3Ds. So deglobalization, decarbonization, and demographics. And all of these are forces that cause structurally higher inflation, which will necessitate structurally higher interest rates to keep that in check. That is a backdrop in which you're going to be looking at different industries than maybe we were over the last 10 or 15 years, different company dynamics. It's just, but this idea that rates are structurally higher just means that every financial asset needs to be analyzed through a different lens.
Right. I mean, big, strong structural headwinds is basically what you're talking about. Let's stay with you on that. What do you consider the impact on company fundamentals to be during, with an increased cost of capital?
I mean, I think one of the interesting things we've observed kind of down on the lower end of the market cap spectrum in the US is just how much more leverage companies have taken on over the last 5 to 10 years. I remember in the 2000s, if a company had a capital structure that was levered 3 to 4 times, it depends on industry, obviously, but if we saw that, we'd get a little nervous. And now we see just tons and tons of companies levered that way, and that became the practice when rates were so low. So the fact that rates are higher, just for these companies that have higher levels of leverage, sets them up for a really challenging period of deleveraging. Capital structures that may have been prudent in the 2010s are no longer prudent today. And then really what we're trying to do is think about input by input, what's going on with pricing power, and input costs. We had raw material pressures in 2020 and 2021, labor pressures in 21 and 22. So we want to find the companies that can offset that with pricing power, and then also companies with high operating margins to begin with, just because the sensitivity to this volatility around the price cost mismatch is just less pronounced for companies with higher margins. And then one point that's interesting, I think, is ironically, higher rates and higher inflation can be actually pretty good for publicly traded companies from the point of view that it's harder to get that competitive upstart funded and started. So the established players actually have a little bit more of a moat by virtue of their access to capital that smaller players will now struggle with.
Yeah, that's a great insight. Jeremiah, from your perspective, how much do rising rates affect valuations?
Yeah, thanks, Michael. And I share the view with the other portfolio managers that we are in for a period of higher rates, certainly higher than what we've seen over the last 10 years. But I may differ a little bit from the mainstream in that personally, I think the correlation between rates and valuation isn't as strong as perceived. I've studied valuations in the US equity market over the last 25 years, and they're actually pretty consistent despite lots of volatility in rates and Fed funds. The multiple on the S&P 500 is normally in the mid to high teens with a dividend yield of 1.7 to 2%. And both have been in that range when Fed funds were close to zero and as high as 4 to 5%. I think the weakness in equities in 2022 was related to lower earnings estimates due to this higher inflation and a disappointing recovery in supply chain reliability and economic growth. Higher interest rates certainly impact demand from consumers and corporations, and as financing costs increase, which has impacted our earnings estimates for 2023 and 2024, I think explain the weakness in equity markets more so than the impact that rates have had on valuations. But based on these adjusted estimates that we've seen, and we'll get into, I think, our market forecast, but I think equity multiples are still in that normal historical range, despite Fed funds now being much higher than a year ago and over 5% today.
That's interesting. I'm not sure most people realize that. So that's a great insight to share. Thank you. Tom, coming back to the cost of cash, do you think it's likely to stay high? And if so, why?
Yes, I do. Yeah. And part of it is what I've already mentioned. I think effectively the political cycle is shifting to the left in the Western world. We can see it in Europe, can see it in the UK. I don't want to speak on behalf of my colleagues in the US, but I think we can see it there as well. That will lead to more pro-labor policies. That's inflationary. Wage inflation is a difficult thing to put back in the box. The second thing actually relates to, well, Jeremiah talked about secular growth. Brian talked about a number of strong, long duration themes, and I absolutely agree with that. We're looking at a couple of decades of some very strong long duration capital cycles led by deglobalization, the shift to a multipolar world. That's incredibly capital, materials, people, expertise intensive. That's going to be inflationary as well. So based on what we can see right now, when you zoom out and take a look at some of these major shifts taking place across the world, it's hard to see how inflation goes back to zero and therefore how rates can follow.
Interesting. So Ben, just staying on that inflation theme, what are your thoughts around inflation protection in this kind of environment?
It's interesting. I think whilst people worry about inflation with regard to equities, actually what we've seen is over the last year is that companies, many companies tend to do better with a bit of nominal growth. So actually, the period that we've just come through, where it was very sort of almost deflationary, and there was not very much pricing power, was quite a tough period for equities because you didn't have room to absorb some of the increasing costs that inevitably come, whether it's IT system upgrades, occasional input cost increases. So I think, a moderate inflationary environment in the past has been quite good for equities. I think you don't tend to see perhaps, the kind of big market re-rating or maybe value re-rating of certain parts of equity markets that you see when nominal rates go very, very low and when real rates go very low. So, but what you see is a bit more dividend growth and earnings growth. So when you go back to the 70s and look at it, the dividend growth was pretty positive through the period and was much more correlated to CPI than it was to GDP. So obviously, to Jeremiah's point earlier, you need to look at companies within that have got a good demand supply balance, particularly companies with brands, companies with some sort of moats, intellectual property moats. I think areas like consumer staples, pharmaceuticals, they don't seem to be having much problem putting through price increases at the moment. So I think, that we're not too worried about a moderate inflation rate environment. It's when you have these periods when you, like last year, where you get very sudden movements, they can be problematic short term, but less problematic in the longer term.
Right. So just, wrapping all that we've discussed today around inflation, stickiness of it, higher rates, et cetera. Recession risk is on everyone's mind right now. So I'd like to take us home with some quick closing thoughts on that topic. We'll start with Jeremiah, but where do you see markets going in the second half of 2023?
Yeah, sure, Michael. So, our base case assumption is that we have limited, if any, kind of real growth here as we go through the second half. As far as our expectation for the market in the second half, my answer depends on where market prices are once we start the second half. But in general, I'm actually bullish on earnings growth prospects, even assuming this kind of slow to no real growth in the economy, because I continue to believe that costs continue to come down. Companies are acutely focused on productivity, which is being driven and enabled by technology investments. The labor market is still healthy. We're seeing signs of improvements in participation, which hopefully will, ease some of that labor cost inflation. And like I said, I think equity multiples are in a reasonable range compared to history. If we end up in an official recession, it'll be the most anticipated recession that I've witnessed in my career. So I think at least some of that is already factored in to the market. I would also argue that certain parts of the economy have already been in a recession with volumes down year over year. We're seeing that in a number of industries, but those industries could start to recover as inventories normalize, supply chains normalize, and they could start to see replacement demand again. And this could offset other industries that start to enter kind of recession and declines in volumes. And so I think there will be kind of multiple movements. And lastly, I think, central banks' interest rates right now are above normal, what I would expect to be kind of the long-term normal. And so if we do see a material slowdown in demand, certainly central banks have some dry powder to help stimulate growth again. So I'm encouraged. It's certainly going to be volatile and bumpy, but I'm encouraged that we could continue to see earnings growth here over the next, 6 to 18 months.
That's great, and that's constructive. Tom, let's flip over to you in London from your chair. What are your thoughts?
I'd largely agree with Jeremiah, actually. I think it's been so hotly anticipated that I'm trying not to exhaust too much of my mental energy agonizing over it, because when we do get some proof, the market may well just buy it. So actually what I'm more focused on and more excited by actually is, again, the beneficiaries of some of these long duration cycles that are emerging, and they're starting to have tangible benefits to many companies selling automated factories, smart infrastructure, anything related to energy security, that we're already seeing the tangible evidence of that coming through, especially through this Q1 results season. So it's important that we make the most of those opportunities. And actually, if I may just drop an example in, because I like to talk about beer almost as much as I like to drink beer. But Brian talked about, he's focusing on investing in companies that have high margins to begin with, that importance of the moat. And I think part of a sort of an outcome of this higher cost of cash environment is that big is beautiful again. And interestingly, if we think about the brewing industry, the craft brewers, the upstarts, the disruptors over the last 10 to 15 years, they're being killed by COGS inflation and by tighter credit conditions. It's a great time to be a big brewer with a 55-60% gross margin and a strong balance sheet. So as well as the sort of long duration cycle beneficiaries that I'm excited about, I'm also excited about those industries where the big guys have maybe lost a bit of share over the last 10 to 15 years and look set to regain it.
Thanks for that, Tom. Brian, just picking up on that, where do you see things in the second half of the year?
I would say that I would agree that it's definitely a highly anticipated recession. What I would say is, every cycle has its own color, but we're sort of in a very unprecedented time, just by virtue of what's happened over the last few years between the pandemic and the follow-up stimulus, which I think makes kind of figuring out the macro backdrop pretty murky. I would note it's a pretty strange dynamic to have had such a resilient equity market in the face of a wildly inverted yield curve, and it's rare the fixed income markets and the equity markets are so disconnected as they are right now. And as an equity guy, I'll say that usually the fixed income folks are the smarter when it comes to prognosticating on the macro. So I think the inverted yield curve is a pretty powerful signal. I would say that against that backdrop, there are lots of individual companies and themes, that should be able to deliver robust earnings growth, adjusted for their cyclicality or the like. Areas like the EV transition or healthcare innovation or the like, where these companies should be able to power through a moderate economic slowdown.
That's great. Thank you for that. And Ben, why don't you bring us home on where we think the markets are going in the second half of 2023?
Thanks, Michael. We're pretty defensively positioned, actually. I think we're a bit cautious. We haven't seen the last impact of a very, very fast interest rate hiking cycle. So I think we definitely feel I'd feel more comfortable on a 12, 24-month view, because I would say, actually, if you look at particularly international markets, we're on 12, 13 times price to earnings ratio, and earnings have come down considerably already. I think it's hard to see. It's easy to see very similar returns to the past on a multi-year basis from here. I don't feel any problem with that. I think for the next 6 months, I would really love to see the debt ceiling debate put to bed. I think it's unnerving to have that knocking around in the background, and that maybe that's the trigger market's looking for. So we're slightly cautiously positioned, but more positive on a 12 to 24 months basis.
Wonderful. Great insights from 4 outstanding portfolio managers here at Janus Henderson Investors. The themes that you're hearing is inflation stickier than what most people maybe think. There's some strong secular trends that will probably keep that pressure upside on inflation. We've got some geopolitical trends that are out there that are also putting pressure there. But there's opportunities. You just got to be more focused on fundamentals, bottom-up analysis, and really be thoughtful about where you deploy capital. I want to thank our panelists today for sharing their outstanding insights. All of you for the opportunity to share our thought leadership with you and keep this conversation going. With that, I'm going to hand it off and back to Sarah De La Garde. Thanks, everyone.